Folks, welcome back to the Taylor Tax Show, the podcast that helps highly paid, highly taxed, high profile, high net worth, and ultra high net worth taxpayers save a bunch on taxes legally and perennially. I'm Terrence Taylor, the co founder of Taylor Tax. I'm an MBA and an EA. This is my co founder, Big Al Darnell Jr. Say what's up, Big Al?
What's going on, everybody? Big Al, and I love my mama.
Big Al is also an MBA and an EA.
All day.
Yeah, all day. Today, we want to talk about episode 40, which is about life insurance and how you use it for strategic gift giving. So imagine wealth beyond life through the ability of strategically using life insurance. That's what we want to talk to you about today. And the way we want to do this is to help talk about why, for those who are fortunate enough to be affluent and to have taxable estates, how using life insurance to gift can reduce those taxes on your estate, help you to transfer wealth efficiently while supporting loved ones and charities that you care about. The most unique aspect of what we want to share with you today is that life insurance actually can serve as a very powerful tool for gifting with tax benefits. Big Al, that's what we love, right? Is the tax benefits angle.
All day. All day.
Just so you know, we're going to be giving you general insights, but here we have to be very strong with our disclaimer. If you do want to act on any of these things that we speak about today, you are very well advised to make sure you consult with a qualified estate planner as well as qualified tax professional for personalized advice for your unique situation. We can cover the tax part. Estate planner would also be helpful for you to talk to. All right, Big Al. So let's talk about the way we've chopped this up for how we want to talk today. So we want to talk about a few things. One, the challenge of gifting for
Yep.
wealthy folks. Two, we want to talk about why life insurance is a gifting game changer. I'm excited about that segment. And then third, we want to talk about how gifting with life insurance, to share some practical ways that you can gift with life insurance.
Mm-hmm.
Next, we want to talk about how you can also go beyond just the tax benefits of
Yep.
life insurance. And then one more thing to cover
Was
is,
navigating the tax and compliance landscape.
yeah, that's right. Thank you, sir. Thank you, sir. So
Yep.
there you have it, folks. And then we'll conclude. All right, Big Al, let's jump right into it, shall we? Well,
Yes,
actually,
sir.
let me ask you right at the top before we jump in. Anything you want to add before we jump in?
Nope. Nope. Go for it.
See, you're getting ready. Look at that. All right, folks. All right, folks.
All right.
So, high net worth folks, the good news is the exemption or exclusion for gift taxes has been raised to 13.99 million per individual. And when you do planning, estate planning properly, especially for those who are married filing jointly, you can double that to 27.98 million. So, for the benefit of this episode, we'll talk about 28 million, but just know that the actual number is 27.98 million,
Yeah.
right? One of the things to think about, though, is that when you are a high net worth individual that has an estate valuable enough to attract estate taxes, you're not dealing just with estate taxes from the federal government. Depending on the state that you live in, Big Al, you might
Yeah.
even have like state taxes, right?
Yeah.
You might have income taxes on the investments you have. And then if you don't properly structure the gifts, there could be some drawbacks and clawbacks. So it's a key thing for you wealthy folks to think about, the high net worth and ultra high net worth taxpayers that we're addressing now. How do you transfer wealth in a way that minimizes your tax exposure while maximizing the impact? That's what we want to talk about. Big Al, can I hit why life insurance is a game changer?
Yes, please. Yeah.
So folks, think about this. When you are wealthy and you're thinking about your gifting strategy, there are many things that are available to you. But I think one of the surprising things available to you is life insurance, right? Life insurance can sometimes be overlooked, though, right? Despite the fact that it's so efficient when it comes to the tax-free death benefits. So you know that anyone who receives that in your estate, death benefit from your estate, they're not going to have to pay income tax on it. The other aspect, and we've talked about this in many different ways, is just that ability to have cash value growth inside a life insurance policy, especially a permanent life insurance policy, whether that's whole life or universal life. So that also allows for use of the policy while you're alive, especially if the estate has need for funds and funding while you're still alive, you could tap the cash value of that life insurance policy. Another aspect, Big L, and many wealthy folks know this, but some may not, is that you can use an irrevocable life insurance trust, ILIT, to avoid estate tax on the life insurance as an asset, because anything that's inside an ILIT would be excluded from the estate taxes since it's in an irrevocable trust.
Correct.
All right, Big Al. So let me hand over to you to talk about gifting with life insurance with some practical examples.
Yeah, definitely, definitely. And those are great points that you made because yeah, eyelets aren't as I guess attractive or talked about as much, on YouTube and some of the other markets that I've seen, but they're an extremely great gifting tool because as we know for 2025, since we are now in the second week of 2025, second or third week, is that now you can gift up to $19,000 before having to report or record an actual gift being made to someone. So, of course, if you're a couple, each of you all could gift $19,000 or $38,000 together. So, one of the strategies is by funding the premiums for an ILET policy for um, your heirs in order to make sure that it stays outside of your state. So let's just say if you were to gift $19,000, $38,000 in premiums every year to your heirs in order to beef up what they get to inherit while also reducing your overall estate that's going to be taxable. Because just like Terrence mentioned, I believe the for a couple it's about 28 million or 27.98 million dollars that you get to exclude from the estate taxes or federal estate taxes when you're gifting. So over time, let's just say if you're 50 years old right now, not saying anybody knows the time or the day anything's going to happen that we move on to glory, but thing is if you and your spouse could start putting away almost 40 million or $40,000 every year, then that lowers your estate every single year. So if you do that for the next 20 years, it could lower by close to what is it,
$760,000.
$160,000. There it is. So that's one of the practical strategies that you can use. And once again, the ILET is an irrevocable trust. All right. Irrevocable, what's it stand for again? LIT, irrevocable
Irrevocable life insurance
life
trust.
insurance trust. I was about to say limit. All right, irrevocable life insurance trust. So now by doing that, it's outside your taxable estate, and this is money that you can give to your children without it being taxed. At 40%, by the way, I'm not sure if we mentioned that. Any gifts or any aspect of your estate over $1 million is going to be taxed at 40%. And that's why we're talking about this so intently in order to avoid almost half of your estate going to the IRS, not to mention states. Now, I believe there's 38 states that don't have an estate tax, but then there's some of them have an inheritance tax. So it's you just have to make sure that you're aware of this, and it's all a state by state basis. But yeah, back to you, Terrence. What could you tell us about the why life insurance, or no, I'm sorry, leveraging and wealth replacement for charitable giving? Oh no, I'm sorry. You're supposed to be talking about. I'm sorry. We'll blame to cut that. Yeah.
So do you want to give the example though of how you could use life insurance to
Replace
donate
charitable giving.
wealth replacement for charitable gifting?
Yes. Yeah. Yeah. Okay, all right.
Just see, folks, this is what I love about Big Al. When he's on something and he gets passionate about it,
Yeah.
go ahead, tell us about it.
Well, I'll tell you this. I thought this was an amazing concept because I didn't quite understand it at first, but when it clicked, it clicked. Now, here's the
Mhm.
thing is that let's just say that you have, because some of our tax strategies that we introduce to a lot of our affluent clients has to do with the donation of appreciated assets. Because the beautiful thing about these appreciated assets is that maybe you invested $250,000 into it. It appreciated to $500,000. When you gift it, you get the benefit of gifting $500,000, even though $500,000 didn't come out of your pocket per se. So that's a huge benefit that you could leverage in order to make sure that you reduce your overall estate tax exposure. So I was giving Terrence the example before we even started the podcast that let's just say that you have an estate that's worth over $40 million. Matter of fact, what is that total exclusion now? $30 million. All right. So let's just say that you have an estate that's worth $40 million. And we know that the estate tax exclusion for 2025 is $30 million.
28, but you're
Oh,
correct.
28, 28. Thank you.
You're
28. So
good.
now we've got $12 million over and above that exclusion. Now, of course, we could put things in place in order to try to whittle that down. But when we're talking about $12 million, gifting $38,000 a year really isn't going to have that big of a punch. But people that have accumulated, in our experience, those that have accumulated that level of assets didn't create or didn't make that from an ordinary income standpoint. They purchased assets that appreciated over time. Some of these assets could be stakes in businesses that you own, stakes in real estate that you own, stakes in art that you have, so on and so forth. So now what you could do, or one of the strategies, is to gift this appreciated asset to a charity. And then you can then try to get insurance. And let's just say if we gifted $12 million to charity, then we could get insurance for $12 million that we're paying a portion on throughout the years in order to replace it so that our children or our heirs still get the $40 million worth of assets. What do you think about that, my man?
And again, folks, for me, working with Big Al is always a privilege and a pleasure, but it's nothing like when Big Al Darnell gets something and he's passionate about it. I'm sure you experienced it too. Goosebump moments. All right,
You
Big
know
Al.
what, Terrence?
Yeah, go for it. Go for
Let
it.
me guess what else?
Tell me.
Guess
I'm
what
listening.
types of charities we could donate this to?
Tell me. Tell me.
We could donate it to our personal family foundation.
Oh, could we?
And
PFA?
of course we could. Imagine donating $12 million to your personal family foundation, which then holds that $12 million, only has to pay out 5% per year. So what's 5% of 12 million?
600K, Big Al. I got you on the map.
My man. So boom, that 600 grand is going towards these charities of whatever you're choosing, but then you can also have your children hired by the Personal Family Foundation, paid a salary from it in
Yeah.
order to continue giving it out while making sure that they still get to benefit outside the estate, the taxable estate. And now you're winning in multiple different ways because number one, you got a $12 million write-off that you get to claim, possibly not that year unless you made what $36 million, because I believe you can only donate 30%.
Some
It'll
people
still
do.
carry forward. So now for as long as you live, you've got the max amount of charitable donations
Yeah.
for giving $12 million to your gifting appreciated assets worth $12 million. It could have only been $2 million or $5 million. All right. So now you get the benefit of the charitable deduction. You get the benefit of having some of your heirs work for the family foundation and getting paid from the $12 million donation that you get. You get the benefit of helping out charities. We're not just doing this just for the tax money, but it's helping out the community and the environment. And then on top of that, it's reduced your estate in a way that you don't have to pay. What's 40% of 12 million? Is it?
40% of 12 million?
Yeah, exactly.
Okay, 4.8 million, I believe.
4.8 million. So you don't have to pay $4.8 million to the IRS in estate taxes. And then guess what? With all those savings, let's just say with the savings, the tax savings that you get from donating 30 million or $3 million, each one of those years, you can use the savings there to pay for the premiums that are going to replace that $12 million so that your children still end up getting a total sum of that $40 million at the end of the day. So it's like it's not even a trifecta. It's like 4 or 5 different compounded components. Yeah, fivefecta, pentafecta. So I think it's a life a game changer, a huge game changer if you know how to do it. And the thing is a lot of this stuff has to do with timing, making sure that you take advantage of the market, the economic trend and markets that we're in, and that you speak with professionals to make sure that this is done properly. But yeah, back to you, my man.
Hey, Big Al, I love the passion. More importantly, I love the insight and the strategic thinking around connecting different dots to help high net worth and ultra high net worth taxpayers not only save a bunch on taxes, but do it in a way that allows them to pass on to their heirs and the causes they care about, the money that they have made during this,
Yep,
the built up in their estate, as opposed to letting that go to taxes.
that's right.
The other thing to think about, folks, before I move on to the next strategy we want you to consider is you could actually create your own 501c3.
Yes, you could.
So, in addition to having your personal family foundation could give the um, 5% of his money to your 501c3 as long as you've structured it properly and it's set up to do things for public good. So, in other words, you can still maintain, or you can structure your gifting in such a way to maintain the ultimate control to make sure the money goes to the things that you really care about. All right,
Correct.
Big Al. Let me hit them with this strategy for their consideration.
Okay.
How about this? For those who have it, you pay a single premium policy, right? And you put that single premium policy via a whole life or index universal life policy to provide a gift in a lump sum fashion into a trust. So you could use a single premium whole life or index universal life policy. The insurance company and insurance agent would work with you to make sure you structure it in such a way that you avoid it becoming what's known as a modified endowment contract. So that would avoid all kinds of nasty surprises when it comes to tax penalties on distribution. But the main benefit that we're going for is that the policy itself is going to grow tax deferred, and then the death benefit is going to transfer tax free to beneficiaries. And this will be outside of your estate if you set it up properly into the right type of trust, right? Big Al, tell us about how do we navigate the tax and compliance landscape just to avoid those like nasty surprises.
Well, yeah. The best way to navigate anything is with good help, with a good guide. All right.
Yes.
And I'm not sure if you've seen any of these Tomb Raider movies or whatnot, but Laura Croft and her dad, they were like excellent, like what are they, archaeologists and guides in the forest and the Amazon and wherever else that they went. But having a good guide, a professional and licensed guide in order to make sure that you can navigate these waters. And then there's an understanding of it's kind of you have to marry, and this is why I think Terrence and we do so well with our clients is because we find a way to marry the creative with the compliant. Sometimes, as you've seen with what was that movie with about the loans back in maybe it's about the 2008, but it's got the guy from The Office, Ryan Gosling in it, The Big Short. The
Oh,
Big
big.
Short. Have you seen that? Yeah. So the thing is like when you have creativity without morality or whatnot, then you get confusion, fraud, and illegalities or whatnot. But when you have the compliance along with the creativity and they balance out, it allows you to really take advantage of things in the most tax efficient way, in a very legal way. That being said, a thing that I was extremely interested in and still am is a generation skipping trust. All right. With a generation skipping trust, what this means is that instead of your children inheriting your estate, you're skipping them and giving it to your grandchildren. All right. Through, I guess the wording inside of this generation skipping trust, make sure you contact a good guide called a trust attorney. And we've got some recommendations for you if you don't already have one. But in doing so, they also have a generation skipping transfer tax, which is 40% as well. So the reason I like the idea is that I, being the fellow that I am fully capable of making sure that my children learn all the aspects that we help them, this is say, buy their first property, that we put insurance in place that they're going to be set up completely from the jump. So now what we want to do is make sure that their children, which is a larger amount because we have two children. You've got two children too, right? Yep. So then let's just say if both of our children have two children apiece, now by allowing it to skip a generation allows your estate to grow even more and then to be so that it can be spread over a larger swath of inheritors. So, but the thing is you got to make sure that you're taking into account the generation skipping trust. However, there are ways between gifting to your children, gifting to your grandchildren, having your children inherit certain things, and then keeping other things inherited to your grandchildren, that can help you avoid estate taxes altogether. Given some of these eyelets, some of the gifting versus insurance strategies and so forth. So we want to make sure that you understand how to do that without, I guess, stepping on your own toes. And that's why making sure that you have a good guide to help you with navigate those waters is beneficial. But yeah, just think about the generation skipping trust as a way to kind of reduce your overall estate, but make sure that you're aware of that generation skipping tax. And there's ways to avoid that too. All right, but anyways, it's all right. Back to you to send us home with the non-financial advantages of insurance gifting.
Yeah, folks. So for me, the best non-financial benefit of insurance gifting is just that sense of accomplishment that folks feel when you know you've structured your estate in such a way that it's going to the things and the people that you really care about, right? So beyond the actual numbers, just knowing that everything that you worked so hard for, you have created a legacy with, and you've now found a way to ensure that it actually protects your family long term. It gives your family long-term security. Just the emotional benefits and the joy that most people experience is the biggest one, Big Al. And then it's not so much a financial thing, but it's more the stress that sometimes comes from folks who inherit illiquid estates. So, if someone has built up a really valuable estate, Big Al, most of the time that's not in cash.
Yeah,
So
yeah,
if the planning is done correctly for the estate taxes and strategic gifting has been used, then you know that your heirs now have like that peace of mind and there's no stress in finding the funds to handle the estate tax. That's also a huge big out. And then last but not least is just also having access during your lifetime to a pot of money via permanent life policy, the cash value that allows you to seize opportunities, or if emergencies come up where you need to tap money, you can use that money instead of having to liquidate your assets. Big Al, let's take this home. This has been a fascinating topic right around our 25-minute mark. So folks, let me just do a quick recap for us. So life insurance is a highly strategic tool for gifting. It offers tax efficiency, flexibility, and the ability to amplify wealth transfer for high net worth and ultra high net worth individuals. We encourage you to definitely speak with your estate planning team and your tax experts to make sure that you get all these benefits we've spoken about. And folks, we'll see you next episode when we will wrap up this 14-part series on insurance, which we've thoroughly enjoyed. We hope you have as well. See you soon.
cheers.